Let's talk to Ronnie Chopra. He's the Chief Market Strategist for Knightsbridge Trading Academy. Very good morning to you, Ronnie.
Good morning.
Right, we got three thought-provoking slides. The headline, the dollar earners. Let's kick off with BP. What's going on here?
They just acquired oil shale interests from BHP Billiton,
Yep.
which has gone down fairly well. They've spent over $10 billion, so it's quite a transformational deal for BP. It's the biggest acquisition that they've made since 1999 when they bought Atlantic Richfield. It's gone down well, as I've said. Earnings enhancing, a large purchase, $10 billion, not to be sneezed at, and it's transformational in that they're going to be increasing their assets in the States, in shale predominantly, and with oil trading around $70 a barrel, they can get oil out at 50. It seems like a very good investment. Also gives BP further growth prospects into the next decade.
Yep.
The shares, as we can see in the chart, have done fairly well since the beginning of this year, rising from around the 470 mark to the current around 550-ish. They offer an attractive dividend yield of just under 6%, major dollar earner.
Yep.
So with the pound at below 127 this morning, that boosts BP's prospects even further. Having said that, we're also obviously at the beck and call of the price of oil. We don't know where that's going.
Yep.
But even if it stays around this level, it's earnings enhancing for BP. Shares attractively priced on a high single-digit price-earnings ratio, and one to tuck away.
One to tuck away. Okay, let's move on to Glaxo. What's going on here?
Again, Glaxo, another major dollar earner. I think they get more than 70% of their earnings in US dollars. Again, since the last few months, they've done extremely well, as we can see in the chart. They're trading around the 15.50 mark at the moment. Again, a very attractive dividend yield in excess of 5%. Amongst the pharma stocks, they've got a massive pipeline of drugs. Prospects look very good. The new CEO wants to possibly demerge the company so that there's more shareholder value. Because going back even 15, 16 years ago, these were trading around £20 a share.
Yeah.
And they haven't really done much in the last 5 years, but in the last 6 to 8 months, they've done fairly well. They've outperformed the rest of the sector. And again, dividend yield of 5% in this relatively low interest rate environment. Multinational company, major beneficiary of a weak pound. So again,
one to tuck away.
It's another good company.
Okay, well, let's wrap up with the third slide, Vodafone PLC. That chart's not nearly as good as the previous two.
No, not at all, and that's why there's an activist investor, Elliot Management, who have picked up a stake in recent weeks. The shares have edged up slightly, but yes, as you say, they're pretty much hovering at an 8-year low.
It's at 8 years, okay.
And again, another major dollar earner, but telecommunications seem to be quite unloved at the moment. But these are offering an incredible 8% dividend yield with the current share price just below 180 pence a share. Again, there could be more M&A activity. They are still a major cash generator. They've increased their interests in Europe. They're still very strong in India and in parts of Africa. One of the largest telecommunication companies in the world. Years ago, these were the largest company in the UK by market cap when they were trading around £3.50. But yes, at the moment, hovering at an 8-year low. Put your contrarian hat on, and
you'd stick a few of these away. But it's quite interesting that the three you've talked about, BP, Glaxo, and Vodafone, have all been subject to sort of bid rumours, merger rumours over the years, haven't they?
Definitely. And you look at also, three of the largest companies in the UK. They're all global, big blue chip names.
Yeah.
All very attractively priced at the moment, major dollar earners. So again, the weak pound obviously helps them. So it's quite baffling to see these big names at current share prices.
Right. And finally, in terms of the FTSE 100 itself, okay, you've talked about pairs trades historically,
Yeah.
buying FTSE to sell Wall Street and the
That's
likes.
it. I mean, I still find the UK market extremely attractively valued because of its much lower price-earnings ratio. Also, the weaker pound obviously gives a boost to the FTSE 100 at the moment. And with Brexit concerns, which sounds strange, but these dollar earners are giving a massive boost to these companies. But having said that, I still find that at the moment, with the whole Turkish crisis as well at the moment that's going on, some of these global indices do look a little toppy, notably the Dow, which is on a much higher price-earnings ratio of around 18 versus around 12 for the FTSE in general. So, we should be playing catch-up. And again, I reiterate the point about the weak pound should be giving a boost to our market. We're a couple of percent below the all-time high. But again, August, September, they're fairly tricky months for markets. We've got very light volumes at the moment. So the moves can be exaggerated as well. And again, currency plays and the geopolitical uncertainty surrounding Turkey at the moment with the very weak lira and the possible effects on the European banks that have lent so much, contagion fears, add to much uncertainty surrounding the markets. But yeah, the deep core strength of the UK market at current valuations make it one of the more attractive markets.
Ronnie, on that note, thank you very much indeed.
Thank you.